Sure. So, we've really been looking at the AI stack. And, when you look at the AI stack today, a lot of the focus has been on chips, on hardware. And that's where, 80% of the value has accrued so far in the last, I would say, 2.5 years. But if you look down the AI stack, you look at chips, obviously right at the top, infrastructure as a service, which are your AWS, your Azures of the world, your Google Clouds of the world, even Oracle. But then you look further down at the software opportunity, at platform as a service companies, at software as a service companies. And there we are finding far more asymmetric opportunities today than we're finding elsewhere in the stack.
Fascinating. Just one more from me. How do you value, because you can't use traditional valuation metrics, and Cathie Wood has had these enormous debates on CNBC over the years about her valuation metrics when she talks about some extraordinary valuations for Tesla, for instance. How do you value, using a traditional one-year forward PE is useless to you, I would say, in many ways. So just for our viewers out there who are trying to make the same decisions that you are, how do you value these companies which have very little profit but enormous potential?
Sure. So, our favorite multiple is EV to EBITDA. And what we're ultimately looking for are companies that can grow into that multiple over a 5-year price target. So we're setting a price target based on our valuation models. And typically we're looking at markets where we're expecting companies to be winner take most. Tesla is a great example of that. They're so far ahead of many other companies in the electric full autonomy space. And so, that's really how we do it. We're looking at sort of setting that 5-year price target and looking at companies that can grow at a rate, even if we're overpaying, today, companies that can actually grow into that multiple exceeding 15% per year. That's our sort of hurdle rate over time, compounded over to actually hit that hurdle, hit that price target over time.
You just broke down the stack for us before, but the reality is some of those hyperscalers are also the software players. What sort of competition do you think we're going to see then in the software space if these hyperscalers have spent so much money and they're looking at every avenue trying to recover it, and whether it's further down in the stack as well through software? So what sort of competition do you expect?
So we're expecting competition. What's interesting in the infrastructure as a software category is you basically have an oligopoly at the moment, right, of AWS, Azure, Google Cloud, and Oracle. And we're expecting that there's going to be some disruption to SaaS, so the bottom layer there, and that disruption is going to come from the platform as a service companies who are really the companies. Some examples would be the Palantirs of the world, the Databricks of the world, that are enabling buying teams, CTOs at large Fortune 500 companies to actually consolidate all their data in one place and then build applications themselves on top of that. Klarna has been a very good recent example where they've announced that they're actually going to abandon their subscriptions to Salesforce and Workday to build more applications in-house. And so we think that that's the kind of beginning of that, but it's really the platform companies gaining market share, we think, at the expense of a lot of those traditional SaaS companies.